Today's market, income investors are searching far and wide for reliable income, with savings accounts offering 4 to 5% and long-term bonds barely keeping up with inflation. A new category of opportunities has entered the scene: high-yield preferred stocks, particularly from a company known as Strategy, formerly MicroStrategy. Now, among these standout choices are STRK as well as STRF, both preferred shares issued by Strategy to raise funds, often for acquiring more Bitcoin. And these investment vehicles offer attractive fixed dividend yields and trade publicly, making them easy to access. But while they may seem familiar, they come with very different features, risk profiles, and strategic purposes. So let's break down STRK and STRF, how they work, how they differ, and most importantly, what risks you need to know before investing, especially in an environment where interest rates are shifting and Bitcoin plays a central role in the issuer's balance sheet. So let's first go over STRK, which is a convertible preferred stock issued by Strategy, and it pays an 8% annual dividend, which is fixed. Take a look at their website. STRK is going to be that 8% dividend yield, and this is based on a $100 share price. On the other hand, STRF is going to be a higher fixed dividend of 10%. Now, why would you invest in STRK versus STRF if STRF has the higher yield? And the main reason is STRK may have a bit higher capital appreciation, as well as once MSTR, which is currently at $374 per share, once that stock price hits 1,000, you can actually convert your shares of STRK to shares of MSTR at a 1 to 10 ratio. That means for every 10 shares of STRK that you have, you can convert it to 1 share of MSTR. And if we take a look at some of these statistics, we can see it has a 12-month return of 12%, a 3-month return of 12%, and a lifetime return of 32%. Compared to STRF, which is a little more on the conservative side, you can't have that share conversion. It's just fixed income of 10%. It has a lifetime return of 22%. And if we take a look at the share price of STRK, we can see it's done phenomenal over the past few months, since February 6, 2025, at a share price return of 23%, not including the dividends. So we took a look at the dividend history. It pays out quarterly. Now that may be a downside for some people who are more interested in weekly or even monthly payments. But we can see it's been paying out some pretty nice cash amounts. The first share was $1.24, and the second share is $2. But after a year, all of these cash amounts should equal about $8 for the year. Because remember, we're basing this off of an 8% dividend yield off of a $100 cash price. If we take a look at STRF, it is also above that 103 threshold mark. Their next dividend amount is actually going to be on June 13th of 2025, so actually next week. And we're getting a dividend amount of $2.63 per share. And if we multiply this value by 4, we pretty much get $10 of a share, because we're going to be getting 4 quarterly payments every single year. And this stock pays a 10% dividend yield. So a lot of people are actually putting a lot of money into this stock, using it as their cash reserve because of how conservative it is. Because remember, this one does not offer any share convertibility. This stock is pure income with no equity upside and just consistent high yield payments. So let's go over why interest rates matter for STRK and STRF. Just like bonds, preferred stocks are highly sensitive to interest rates. When rates go up, the value of fixed income instruments typically go down. And STRK and STRF are no exception, because these are both stocks that pay fixed income. If new investments start offering higher yields due to rising interest rates, your 8 or 10% yield might not longer seem attractive. So as a result, buyers in the open market demand a discount on price to bring the yield back in line. So let's say STRF trades at $100 per share and it pays $10 annually, which is going to be a 10% yield. If interest rates rise, investors might demand 11% yield instead. And to reach the 11% yield, the price would have to drop to around $9 per share while still paying that $10 annual dividend. So while the dividend amount stays the same, your share price can drop significantly just to reflect current market conditions. And this is called interest rate risk, and it affects both STRF and STRK. So in my opinion, the best time to get into these stocks would probably be closer to the $100 price point. Because right now, if you're paying over $100 for these shares, you're going to be paying a little bit more of a premium and your yield is going to be slightly lower. Because remember, this stock STRK is going to pay $8 annually and STRF is going to pay $10 annually. So you want to get a lower share price if you can. So who should buy STRK? STRK is ideal for investors who want steady income now with the potential to profit if strategy stock soars. And that will likely happen due to a surge in Bitcoin. It's a hybrid play, part bond, part call option. But if you don't believe Strategy's common stock will ever hit the $1,000 threshold mark, the convertibility might not be worth much, and you're better off collecting the 8%. Now, who should buy STRF? STRF is a better choice for investors who want maximum income with minimal complexity. It's a straightforward 10% yield based on a $100 value with no strings attached. If you're planning to hold long-term and aren't interested in trading stock volatility, STRF may suit you much better. But if you're looking for that upside potential, STRK is for those who want income with also the upside potential and are okay with a slightly lower dividend yield to make up for it. But both of these preferred stocks, both STRK and STRF offer compelling yields for above traditional bond yields or savings accounts, but they come with trade-offs. Both are exposed to interest rate risk, market volatility, and company-specific risks due to Strategy's large Bitcoin exposure. And with any investment, it's important to consider how long you plan to hold, your risk tolerance, and whether you'd be comfortable holding if prices drop. So in the end, these preferred stocks can play a valuable role in a diversified income portfolio as long as you understand the risks behind the yield.